What is up, YouTube? This is the Working Investor. In this video, we're going to talk about a mindset when it comes to high yield dividend ETFs. Another way to think about it and evaluate them is defensive versus offensive. There are some high yield dividend ETFs that give such a profound dividend that I call it's so much on the offense that, if you have a really good team and your offense is so amazing, you may not need to worry so much about the defense because your offense is just scoring those, getting those points. But and then there is ways to play defense where you're not getting such a high dividend, but at least it should be defensive. So let me go a little bit more into this definition, because not always are, you have to compare apples with apples, oranges with oranges, and there's something called risk-adjusted return. So if you're getting a lower high-yield dividend ETF percent, you want to make sure that that lower percent, that trade-off, is at least protecting your downside. Now let's go into this definition, what I mean by defensive. So when I say defensive, it means less volatility compared to the underlying. It's relative NAV stability, because if you are trading an underlying that's extremely volatile, then I would consider zero. When you're doing these option premium based ETFs, you want to make sure that your volatility is at least better than the underlying. So if you're trading a very risky underlying, then you're going to expect risk, but you want to make sure that your risk is not greater, so you want to have your risk less than your underlying. Most of the high yield dividend ETFs out there in this space right now are covered call ETFs or synthetic covered call ETFs. And in general, covered call ETFs perform better in neutral, bearish, or slightly, when I say slightly bullish environments, slightly means up until the strike price. So some ETFs go about between 0.25 basis points. They write calls just a quarter of a percent above the trade, and maybe even up to like 0.5% or 1%, right? And there are other ETFs out there, which I've heard in an interview with Rec Shares, that they do, let's say, about 4.5% out of the money. So they give you some breathing room for some upside up to 4.5% in a month. So they're not all the same, but in general, what I mean slightly is up until the strike price. So in general, they should perform better in neutral, bearish, or slightly bullish environments. But if it's a tremendously bullish environment, they may underperform based on the market. Then there are ETFs that are spreads, which is defined risk. Your risk is only up until the width of the spread. And then, like we spoke about, defensive plays means less premium, but more room for capital appreciation. If your defensive play is not giving you a lot of room for capital appreciation, it may not be worth it. You need to evaluate. Offensive play means, as we spoke about, much higher premium, but less potential upside. But if you're getting, a lot of premium, it may make up for that. Let me give you a case in point. Let's say you have a high yield dividend ETF that gives 100% return, and there are 100% plus return paying ETFs out there. Whatever percent annualized return you have, just do this quick little formula, just divide it by 12. And then, for example, for the 100% return, if you divide it by 12, that's 8.33% payout every month. It goes up and down, but more or less. But that means that you have a buffer, because sometimes people say the best defense is an offense, a strong offense. So if you're playing soccer and your offense is just killing it and you're just making goals, you can have a goalie asleep in the net, and I'm sure you've seen these games where the goalie doesn't have to do anything. There's no work for the goalie. So you do have every single month an 8.33% buffer. So if your underlying drops under 8.33%, it drops 2%, 3%, 4%, 5%, you're still at a net gain. So that extreme rich offense gives you a tremendous buffer. And this is, let's say, hypothetically per month. So they're not all the same. And let's go through a couple comparisons over here just to really illustrate the point. So I have this little chart here. This is just with the NASDAQ, some NASDAQ comparisons. So I know it's a lot of different things. I'll explain it to you. So you have the NASDAQ one you have the this one over here, which is the yellow. So the Nasdaq year to date, you could see here is up 20 point, the second one, 20.91% year to date, according to Google Finance, right? So that's let's say we'll call that as our baseline. We're going to compare everything to that right now. Then you have a fund called NEOS. And NEOS, they tend to do, they try to give you a little bit more upside. They do covered call writing. And you could see here, NEOS is up 2.8. It did capture about 10% of that. It captured 2.79%. And then you could see here, this is their QQQI, and they tend to look for, a distribution rate of 15.16%. So you're getting 15.16%, but you've also captured about 2% of the upside, not over the whole year, but year to date. Let's go back over here. So the next example, we have the famous DEFIANCE, QQQY. So QQQY year to date, not full year, but year to date, it's down almost 30%, right? So yes, it is down. But if you look at the, it's a strongly offensive move, and it does in the money puts. So let's go over here. I like this website, NASDAQ.com, because it calculates, I had some people say you need to look at actual distribution. So this actually calculates the entire year of dividends that you've received of $41.51. Guys, that's insane. And you could see from the dividend yield, based on actual dividends. And again, we're actually about to go to X date in coming up this week. So, and this will be, we're anticipating a pretty chunky dividend. So, bear in mind, put that into consideration. But 113%. So if something is down, what do we say? I think we said about 30% year to date, or if you want to say, year to date. But if you really want to look for, over the past year, the 12-month rolling, you could see here, where is it? It's down 38%. But even though it's down 38%, but if you're getting 113% on the offense, the offense is so powerful. Even though the opposite team shot a couple scores into your net, they got you lost some points there, but your offense is a beast of an offense. You've kicked their butt because you won. Okay, they got a couple goals into your net, but for every goal they put in your net, you've hit like 2 or 3 goals in their nets. So you basically took them out. So that's the defiance. And then you have the Rex shares, I call it kind of in the middle of the road. And Rex shares, and I listened to the entire interview with Rex shares, and basically they like to write 4.5% on average. They were just talking about an interview with, I think it was Retiring Dividends, that they like to write they actually own the shares, sell cover calls themselves against their own shares from the index, not the index itself. So they have more volatility because they have more premium because it's actually individual shares from the index. And you could see here, Rex shares, let's say for the past year is down 1.2%. Year to date, it's down 6.48%. But Rex shares, okay, if you want to go 1 year because you want to look at 12 months, the reason why I didn't do 1 year is because some of the funds haven't been around for a year. So I was trying to, let's say FEPI, has paid out $13.10 over the past year, and it has an annual percent of 25.6%. So it's kind of in the middle of the road. But you could see here that it was down a couple percent. So you're still net up more than 20% year over year. So that's pretty good too. It's kind of like, in the middle of the road. So you want to think about your strategy. Are you a defensive player? Are you an offensive player? Are you kind of like more of like a balanced player? You have to think about your style of investing. Again, this is not financial advice. It's just some observations, and I'm not telling you to trying to steer in any of these funds. I'm just, trying to show you what my understanding is. And then, of course, there's the famous Roundhill, but we don't have enough data. It's been around for 6 months, but, Roundhill, basically, where are we at? We're losing it over here. Here we go. So it's down for the past year. Well, I don't even think it's been around for a year. So year to date, it's down about 8.4%. I think it's about arguably somewhere between 38-40%, somewhere there, but we'll figure it after we have a full year of data. But you could see here, your net, it looks like it's going to be roughly maybe a 30% netter, but time will tell. It's kind of like also in the middle. I would look at this more like in the middle of the road. It does give you it does give you, I know that, based on, I was watching the Income Architect, where is it? And he was putting in a chart based on this week's plays. You could see that on the out of the money, the second to the right, you could see every day you see 0.57% out of the money, 0.36, 0.29, 0.33, 0.36. So if you get an idea, roughly somewhere between 0.29%, so 29 basis points out of the money this past week, and this is on QDTE, and it went all the way up to 0.57% out of the money in basis points. Now, in a way, it seems very modest that you're only giving yourself a fraction of a percent of upside. But remember, this is every single day. So if you're like if you're let's say even on the low side, 0.2, 0.3%, let's say 0.3, super on the low side from their out of the moneyness from this week. We'll see. It's hard to extrapolate, but let's just be on the more conservative side. So, Monday, Tuesday, Wednesday, Thursday, Friday, that's 5 days. So 0.3 times 5 is 1.5% total. They're giving themselves over the week a potential of up to 1.5% capture. But of course, not every day does the market go up. Some days it goes down, but the days it goes down in neutral, it's still outperforming. Remember, cover calls outperform in relative to the market in neutral to bearish, slightly bullish. They don't give much upside. So, but over, even let's say every single day the market's up. So they're able to capture about 1.5% on the more conservative side per week. 1.5%. If you have a whole year, which is, I don't think a whole year, every single day the market will be up, they could capture quite a bit. It adds up from day to day, week to week. So they do get some upside, possibly some upside. So anyways, yeah, this is my pretty much my way of looking at it. Like I said, offensive versus defensive versus you have a team that's maybe a little bit of both, kind of around, like a middle of the road type of play. And and again, everything is relative to the underlying. Of course, if the NASDAQ would drop, if we have a black swan event, everything would be down. But I would not consider it down if it's not more down relative to the underlier, because you do have the underlier risk. I'm talking about, adjusted for the underlier. That's what we're talking about. What do you guys think? How do you guys look at these funds as far as risk stratification and, offensive versus defensive? Let me know. Anyways, the Working Investor over and out. Have a wonderful weekend.